Welcome to the deep dive. Today, we've gathered, well, quite a stack of material, haven't we?
We certainly have. Financial filings, press releases, investor presentations, all focused on Aadhar Housing Finance Limited.
Exactly. We're looking at their Q2 and half-year results for FY26. And this is, a really interesting company.
It is, because they're a major player, but focused entirely on India's affordable housing segment.
So our mission today.
Well, we have all these numbers, right?
Yeah.
Filings, releases. The goal isn't just to read them out. It's to synthesize what they mean. How's the company doing? Is their strategy holding up? And critically, how are they positioned in that affordable housing market?
Right, because they're lending mainly to the economically weaker section, EWS, and low-income groups, LIG.
Precisely. Which, traditionally comes with perceived higher risks. So how do they balance growth and profitability there? That's the core question.
Okay. And looking at the headline numbers for the first half, H1 FY26, the growth definitely jumps out.
It really does. Assets under management in the AUM, that grew by 21% year over year.
21%, wow, bringing it up to Rs 27,554 crore.
Oh, it's robust. And importantly, this isn't just growth for growth's sake.
Meaning?
Well, look at the income and profit. Total income also grew strongly by 18% to Rs 1,751 crore.
Okay, 18% there.
And profit after tax, PT, matched that exactly. Also up 18%, hitting Rs 504 crore.
So consistent growth across the board, high velocity, like you said.
Exactly. Especially when you remember their average loan size is just over 10 lakh rupees.
Right, tiny tickets. So achieving 21% AUM growth means they must be originating a huge volume of these small loans.
That's the engine. High volume, small ticket, socially focused lending.
So let's really unpack that core mission, focusing on EWS and LIG. What does that mean in practice? Who are these customers?
We're talking about people often underserved by traditional banks. First-time home buyers, maybe moving from informal settlements, or folks in the informal economy.
People without maybe extensive paperwork or documented credit histories?
Often, yes. And Aadhar's commitment here isn't just talk. The documents show, as of the first half, 64% of their gross AUM is specifically with these EWSL customers.
64%. That's the bulk of their business.
It is. And that average loan size you mentioned, Rs 10.5 lakhs. Let's put that in perspective.
Okay.
For listeners elsewhere, that's roughly, $12,500 US. We are talking about genuine micromortgages.
Which, as you said, changes the business model fundamentally. You need extreme efficiency to make that work.
You do. High operational costs would kill the margins. But the flip side is reach and scale.
How many customers are we talking about?
Their filings say over 315,000 live accounts currently. That's a massive customer base spread across the country.
And the revenue seems stable, driven by interest income primarily.
Yes, the sources confirm that. Interest on these loans brought in about Rs 15,028 million for the half year. It's very straightforward. Income comes directly from their core lending.
Okay, speaking of being straightforward and disciplined, let's touch on their IPO from 2024. There's always interest in how that money gets used.
Right. And they were very clear about it in the materials. They explicitly state there was zero deviation from the plan outlined in the prospectus.
So the funds went where they said they would?
Exactly. Out of the Rs 100,000 lakhs raised in the fresh issue, R 75,000 lakhs went straight into onward lending, fueling that AUM growth we saw.
Okay.
And the rest, about Rs 20,233 lakhs, went towards general corporate purposes. All accounted for, no surprises.
That kind of follow-through is important. Definitely builds confidence before we dive into the deeper financial health metrics.
Good point. Let's pivot from growth to the foundations. Given that EWS-OG focus, how stable are they really? Is there a risk of growing too fast and compromising quality?
That's always the balancing act, isn't it? But the ratios seem pretty solid.
They really do. The sources suggest they're managing that trade-off quite effectively.
Let's look at return on assets, ROA.
Okay, ROA.
Holding steady at 4.2% for H1 FY26. That's a strong number. And return on equity, ROE. That's often a key one for investors.
Stood at 15.1%. And remember, that's after the IPO capital infusion, which tends to dilute ROE initially. So hitting 15% is quite good.
But the number that really caught my eye was the capital adequacy ratio, CRAR.
Ah, yes. It's exceptionally high.
How high are we talking?
44.3%. And Tier I capital is basically the same, also 44.3%.
Just 44%. That seems massive. Why so high? What does that signal?
It signals a very, very conservative approach to their balance sheet. It's way above regulatory requirements.
So it's a buffer.
A huge buffer. It protects them against unexpected shocks and counters any perception that their fast growth might be reckless. It says they have the financial muscle to sustain this growth without taking on excessive risk or leverage.
Okay, that makes sense. And what about operational efficiency on the lending side, the spread?
Also stable.
Yeah.
The spread, basically the difference between their loan yield and their cost of funds, held steady at 5.9%. So they're maintaining their core lending margin.
Which brings us, I think, to the absolute critical question for a lender in this space: asset quality.
The million-dollar question, or maybe the 10 lakh rupee question here: how are the non-performing assets, the NPAs, looking?
Surprisingly low from what I saw, given the potential challenges with documentation and income streams in this segment.
Agreed. The gross NPA, or GNPA, that's the total value of loans overdue by 90 days or more, stood at just 1.42% of AUM.
Only 1.42%. That's impressive.
It is. And the net NPA, NNPA, which is the GNPA, minus the provisions they've set aside for bad loans, is even lower at 1.0%.
So NNPA at 1.0% means they're provisioning adequately for the bad loans they do have.
Exactly. It shows good risk management. And that low GNPA itself, 1.42% for a portfolio dominated by EW SLIG, tells you their underwriting, their technology, their collection processes. They must be working really well.
And they seem to be cleaning up older issues, too. I saw something about the COVID-related stress accounts.
Yes, that's a good indicator of portfolio health. The number of accounts that were restructured under the RBI's COVID Resolution Framework 2.0 but remained standard, that number dropped significantly.
How significant?
It went from over 20,000 accounts at the end of March 2025 down to about 18,000 by September 2025. It shows those stressed accounts are resolving, recovering.
Right.
The portfolio is de-stressing.
Okay, so the financials look strong, stable, and the asset quality is tight. But how are they doing it, especially reaching these customers in, potentially remote areas?
Right. The how is crucial. It comes down to two things, really: their physical reach and their digital backbone.
Let's start with the physical reach.
The branches?
It's extensive. 611 branches spread across 22 states and union territories. That's a huge network.
And diversified too, right? I think I read no single state has more than 15% of the AUM.
Correct. The diversification is key for risk management, avoids being overexposed to any single regional economy.
But it's not just standard branches, is it? They have different types.
Yeah.
Exactly. They use a very granular strategy. They have main branches, small branches, even micro and ultra micro branches.
Ultra micro, what does that suggest?
It suggests deep penetration. They're clearly reaching into Tier 4, Tier 5 towns, places where you might not find many formal financial institutions.
And they use local agents, too, the Aadhar Mitras. Tell us about them.
Ah, the Mitras. It's fascinating operationally. It's about leveraging existing community trust.
How so?
These Mitras aren't typical financial agents. They recruit people from completely different local businesses. Think vegetable vendors, cement dealers, maybe a local shop or a saloon owner.
Really? Why them?
Because these individuals are already known and trusted within their local communities. They have the local knowledge, the network. They're effective for referrals, finding potential borrowers, and crucially can also help with follow-up and collections because they're right there on the ground.
That's clever. Deep local intelligence built in. But processing hundreds of thousands of tiny loans through local agents across tiny towns sounds like a logistical nightmare. How do they keep costs down?
That's where the second pillar comes in, the digital-first operating model. It's not just a nice-to-have. It's absolutely essential for making this model profitable.
So technology is key.
Absolutely. Their core system is from TCS, and speed is everything. Look at their door-to-login time.
What's that?
The time from the agent first meeting a potential customer to getting the application formally logged in the system. They claim it's just 25 to 35 minutes.
25 minutes? That's incredibly fast. That has to cut down processing costs significantly.
It does. And they also mentioned 100% paperless onboarding. Everything's digital. Think of the savings on physical paperwork, storage, manual processing, reconciliation.
Okay, so digital efficiency drives down cost. But how does tech help with the risk side, especially when traditional credit scores might be missing?
This connects directly back to that low 1.42% GNPA. They can't rely solely on standard credit checks. So they lean heavily on data science, AI, machine learning.
AI underwriting for micromortgages, how does that work?
They use application scorecards built with AML, likely incorporating non-traditional data points to assess risk where formal data is thin.
Okay.
And it's not just for underwriting. They use it for collections, too. They have this RAG, red, amber, green segmentation for overdue accounts.
Well, I agree. So they're prioritizing.
Precisely. AI helps score the overdue accounts, flagging the high-risk red ones so the collection teams know exactly where to focus their efforts. It makes collections much more efficient.
Even deciding where to open a new branch uses tech.
Apparently so. They mentioned using geospatial analytics to pinpoint underserved areas with good potential. It's tech integrated end to end.
Right, so the picture emerging is this blend of grassroots reach through the Mitras and sophisticated digital operations. Very efficient, very disciplined. Now let's look ahead. The CEO's comments suggest things could get even better.
Yes, the outlook seems very positive, driven by some big macro factors and government policy.
Like what?
Well, one thing mentioned is potential GST rationalization. They call it GST 2.0. The thinking is this could lower construction input costs, making the final house, and therefore the loan amount, more affordable for their target segment.
Makes sense. And government housing initiatives, those seem huge.
Absolutely central. Programs like PMAY Urban 2.0, the Pradhan Mantri Awas Yojana, that's targeting 30 million new houses by 2029.
30 million.
Yeah. And other initiatives like Angie Card 2025 focus on improving living standards in these communities. It creates a sustained, multi-year demand pipeline.
So the government is actively trying to solve the housing shortage. How big is that shortage estimated to be?
The numbers are quite stark. The projections suggest the affordable housing shortage could reach 32.3 million units by 2030. That includes the current estimated gap of around 10 million units.
Wow, that's a massive societal need.
And it translates into equally massive financing opportunity.
How big are we talking financially?
The potential market size for affordable housing finance is estimated at INR 45 trillion.
45 trillion rupees. That sounds astronomical.
It is. For context, that's about 3.5 times the current outstanding loan volume in this segment, which is around INR 13 trillion.
And housing finance companies like Aadhar are well positioned.
Very well positioned. HFCs currently hold about 53% market share of affordable housing loans. They're the dominant players.
Okay, so let's tie this all together for the listener. We started wondering about growth versus stability.
And the sources seem to confirm they're achieving both. You've got that strong 18-21% growth in AUM and PAT.
Right, but paired with really tight asset quality, that 1.42% GNPA.
And massive safety buffers like that 44.3% CRAR.
Plus, this sophisticated operational model, the local Mitras, combined with the digital-first processing and AI.
Exactly. It allows them to profitably serve a segment others might find too difficult or costly.
So when you look at that projected 45 trillion rupee market opportunity fueled by government policy,
Aadhar Housing Finance looks, well, perfectly positioned to capture a significant slice of that pie. They have the foundation, the reach, the tech, and the focus. #outro.
so the synthesis really is clear, isn't it? It's a story of focused execution.
Yeah, successful execution in what's often seen as a challenging market segment. They're making financial inclusion work at scale.
How? Like merging that deep local connection, the Mitras, with, advanced digital tools and AI for risk management.
And the numbers seem to back it up. The results validate the approach.
Okay, so key takeaways for everyone listening. Sharp focus on EWS ELEG. Check. Transparent use of IPO funds. Check. Impressive asset quality driven by technology. Check.
And a huge market opportunity ahead thanks to policy support. Check.
All right, before we wrap up, time for our final provocative thought.
Okay, here's something to chew on. Aadhar relies heavily on digital processing and data science, AI, to reach these remote EWS-led customers where, let's face it, documentation can be patchy. So the question is, as this massive wave of demand driven by government policy actually hits, will it force their AI credit models to mature even faster? Could they end up setting a new, replicable standard for efficient AI-driven lending across the entire financial inclusion sector, way beyond just housing?
Using policy-driven demand to accelerate tech innovation and lending. A really interesting question, linking that local agent to global tech trends. That's definitely something to think about.
Indeed.
And that's a wrap on this deep dive. Thanks for tuning in.